Hello, my name is Mohammed JULKIFLI, and I'm here today to present my group work. The title is Climate Risk and Banking.
So, climate risk overview. What is climate risk? Climate risk refers to possible financial effect of climate change on economic entities, such as central bank and other financial institutions, which are referred to as eliminate risk. Physical risk. Climate change effect. Altered weather pattern, rising sea level, increased frequency of extreme weather events such as storm, flood, and drought. Transition risk, regulatory risk, market risk, and technology.
There are three transition risks. First is regulatory risk. Changes in law and regulation aimed at reducing greenhouse gas emission can lead to increased costs for business, impact asset value, and require significant operational adjustment. Second is market risk, which is shift in consumer preference and the demand for green technologies can alter the competitive landscape, causing financial loss and decreased market share for business that fail to adapt. And technological risk, which is rapid technological advance can render existing product and processes to obsolete, putting business that do not innovate at a competitive disadvantage.
This figure illustrates this level. An international banking group embedded climate risk into count, counterparty rating. So you can see lah, we have a idiosyncratic adjustment, mitigating and adaptability capability, inherent risk score, and residual risk score.
There are three practical challenges in managing climate risk. First is heterogeneity in reporting standard. Second is limiting in this assessment model. And third is data availability and quality. Impact on the Malaysian economy, there are at least 15 natural disaster events occur in the past 20 years, which resulting 8 billion ringgit losses. Around 3 million people are affected by it, and 32.7% declining in the earning of fishermen and 5.7% declining in agriculture sector. 14.2% of GDP agriculture sector are susceptible to output loss, and 11.7% of fish exposure to sector potentially exposed to climate change. Impact on the economy, physical risk. There are three impact on the economy by the climate change. First is disrupting supply chain. Second is damaging property and infrastructure. And third is affecting labor productivity. Exposure of Malaysian financial institution. So 10-20% of total asset of bank are potentially exposed to climate change, while 24.4% are of total asset in the insurance company and takaful operator are potentially exposed to climate change, and total combined exposure is 11.7%. There are few ways for tackle this climate risk. First is from defensive tactic, and second is from offensive tactic. Alongside these two tactics, there are also body that play a big role. For example, international bank and offshore bank both is responsible for find a solution for climate risk. Climate risk impact on the banking sector. Climate risk poses significant challenge to the banking sector, affecting various aspects of the operation, risk management, and long-term sustainability. From the physical risk, we have credit risk, market risk, operational risk, insurance coverage, impact on profitability, geographical concentration. For the transition risk, we have credit and market risk, reputational risk, impact on financial stability, regulatory changes, and operational adjustment. For the regulatory and policy framework, global financial crisis of 2007 to 2009. Background of crisis, lack of effective bank regulation and supervision. Key issues included excessive risk taking, lack of transparency, and insufficient capital buffer. In response, policymakers introduced various regulatory reform aimed at enhancing the stability of banking sector. Key regulatory reform. First, higher capital adequacy, which is banks are required to hold more capital to absorb potential losses. Second, restriction on bank activity, which is limiting certain high risk activity to reduce overall risk exposure. And lastly, improve transparency, enhance disclosure requirement to provide better information to regulators and investors. Impact of the regulation from positive aspect increase financial stability and reduce likelihood of bank failures. From negative aspect, potential constraint on bank liquidity creation and profitability. There are four global regulation or regulatory body. First is Special Committee on Banking Supervision (BCBS). Second, International Monetary Fund (IMF). Third, Network for Greening the Financial System (NGFS). And lastly is European Union (EU). There are four examples for national regulation. First is Australia with APRA. Second is China with China Banking Regulatory Commission. Third is UK with Bank of England and Prudential Regulation Authority (PRA). Finally, there are USA with Community Future Trading Commission (CFTC) and Security and Exchange Commission (SEC). There are four market innovation. First is embedding climate risk into credit risk management. Banks should assess the credit business strategy to address climate change issue by identifying the market, segment, and client they will serve and by offering innovative product. Second is climate risk assessment and stress testing. Bank need to develop new method to quantify climate risk at both the borrower and portfolio level and conduct stress testing using various climate scenario. Third is collaboration and data sharing. Bank can collaborate with insurance firm and other entity to design derivative contract for climate risk, which can help in hedging climate related risk. And lastly is climate resilient portfolio management. Banks should develop strategy to manage climate risk in their portfolio, including identifying and mitigating climate-related risks and preparing for potential losses like monitoring and managing credit portfolio, including those of new and existing clients, and conducting stress testing using different climate scenario. Role of financial center in promoting climate investing. There are three main type of organization. First is IFC, which are responsible for major global financial hub that facilitate a large volume of international financial transaction. Second is RFC, which serve as financial hub for specific region, facilitating financial transaction within those region. And finally, we have OFC, OFC are jurisdictions that provide financial service to non-residents on a scale that disproportionate to the size of their domestic economy. There are few ways for implement priority for climate change. First is from IFC. Uh, IFC like New York, London, and Tokyo facilitate large-scale climate financing projects by leveraging their deep capital market and access to global investors. Second is from RFC. RFC like Kuala Lumpur, Sydney, and Dubai focus on financing climate projects that have a direct impact on their region, such as renewable energy project and sustainable urban development. Finally, we have OFC. OFC, such as the Cayman Island and Luxembourg, offer tax-efficient structure that can attract climate investment by reducing the overall cost of capital. Promoting conscious investing. Climate conscious investing is a potent weapon in the financial world toolbox to address the challenge facing our planet. This strategy goes beyond just earning a profit. It involves allocating our resources wisely in the direction of a sustainable future. The key principle of conscious investing include aligning investment with personal value, promoting sustainable business practice, and measuring the impact of investment on society and environments. These are important since the investment impact on these few factors: environmental, social, and governance. Knowledge and expertise, stakeholder engagement. Maintain clear communication with stakeholders such as investor, regulator, and customer on the bank climate risk management method and performance. This can be seen from the report of the Climate Financial Risk Forum held some years to celebrate the forum's achievement over the past year through a varied program of speeches and practical sessions. Provide regular update and report on the process toward climate-related targets such as achieving net zero emission and boosting green financing activity. As such, the annual report from the Task Force on Climate-related Financial Disclosure are one of them. Technological integration. One of them is using technology and data analytic to enhance climate risk assessment and reporting. This include applying artificial intelligence and machine learning to massive dataset to uncover pattern and trend connected to climate risk. So if you're looking from the picture here, there are climate four phase from climate risk management, which is identification, measurement, monitoring, and control. So we can use the AI and ML to help us on climate risk management lah. Regulatory framework and guidelines. We have three key entities and initiatives. First is Bursa Malaysia, which introduced guideline for ESG practice. Second is Malaysia GIIO, which provide detailed assessment of project viability and sustainability. And lastly is MIDA, which offer tax incentive, grants, and financial support. There are three guidelines and practice. First is ESG reporting. For company must disclose environmental impact and sustainability effort. Second is investment opportunities for identification of viable green project. And third is incentive and support mechanism for tax incentive for green investment. Bank strategic response to regulatory and policy initiative. Adapting to regulatory requirement. Compliance with frameworks such as TCFD require bank to disclose climate-related financial risk. The guidelines stated by the UN when being affiliated with NZBA had become the foundation of the whole NZBA to achieve its desired result. Alignment with ECB guideline on climate-related environmental risk, which mandate integrating this risk into governance strategy and risk management process. So we look from the picture beside, these are four guidelines that agreed by the NZBA. Policy integration. Banks are incorporating climate risk into their strategic planning, considering both risks and opportunities arising from climate change. Development of green finance products such as green bond and sustainability linked loan to support the transition to a low carbon economy. So from the picture here, we can see that there are three opportunities and three challenges from the climate change. Engagement and advocacy. Banks are actively participate in policy discussion and industry initiative to shape and respond to regulatory changes. This include involvement in global initiatives like the Net Zero Banking Alliance, collaboration with regulator and policymaker to create a supportive framework for climate risk management and sustainable finance. Integration into risk management framework. Climate risk is being integrated into several risk management framework, including credit market and operational and reputational risk. Develop climate risk assessment tool and procedure, including stress testing and scenario analysis to analyze the impact of different climate scenario on financial sustainability. In this diagram, we can see Bank of England five pillar in supporting the net zero emission economy. Disclosure and transparency. Transparency is in reporting climate-related financial risks and opportunities include detailed qualitative and quantitative information. Enhanced climate risk disclosure in line with TCFD recommendation covering governance, strategy, risk management, and metric and target. By reporting being given annually, the layout of progress of TCFD can progress and improvise as they encountered issue. There are three collaboration with financial center and its effort. First is international collab. Organizations such as the BCBS and EBA play important role in defining global standard. Second is regulatory framework. Financial regulatory body in various regions have been actively developing and implementing principle for managing climate-related financial risks. And lastly is implementing challenge and support. Bank confront various challenges when implementing climate risk management and approach, including incorporating climate risk into current risk management framework and governance structure.
Challenge and opportunities.
There are three challenges. First is data quality and availability. Due to the lack of standardized data and methodology, it's hard for bank to get reliable and high quality data on climate related risks, thus hinder their ability to effectively assess and manage this risk. Second is regulatory compliance. Bank has to abide by a number of complicated and time consuming standards and rules pertaining to climate risk management. Third is resource constraint. Large amount of money must be spent on technology, knowledge, and resource in order to develop the capability needed to handle climate hazard. There are also three opportunities. First is enhanced risk management. Climate risk management can assist bank in detecting and mitigating potential loss from climate-related event and transition. Second is regulatory alignment. Regulatory bodies are increasingly focusing on climate risk management, which can help bank manage this risk while also aligning their operation with regulatory requirements. Third is market opportunities. The integration of climate risk into banking operation can open up new market opportunities for banks such as green financing and investment in sustainable infrastructure.